So we're back down here at the river. Thought I'd give another shot at catching some fish. Wasn't too successful last time, but also wasn't conditions weren't optimal for that. So we're gonna try to catch some catfish today. I've got some stink bait down here. I'll get ready on the line and then see if the rain we had over the last week or so was able to bring up the water enough to bring some bass into the area. So that's what we're gonna do. We're gonna rig up some of the rods here. One for catfish that might be sitting on the bottom out here in a hole, and the other one just to do some casting and see if we can drag a bass out. So we'll do that, and then we'll get to also doing the review of basically the last 3 chapters, kind of hitting the high points and reviewing what I think the key elements were and what at this point you should be familiar with and comfortable with knowing regarding financial accounting. Well, with that, we're all rigged up. Let's get these casted out and start talking about basically the review of the first couple weeks of intermediate accounting. Okay, so we're gonna cast out here and see right into this deep spot over here and see if we can get any catfish. There's a couple out there. I've seen them around. I've caught some before. So we'll cast it out there. We got some stink bait on here and see if we can get any luck. Okay, we're all rigged up, and we've got the catfish line out right over there, and we'll see if something bites there. If we do, I'll take a quick break and reel that in, try to let you guys see that as well. In the meantime, I'm going to fish the regular spinner line with the spoon on it, see if I can bring in a bass with the water up where it is. So that's what we're going to try for today. We're also going to talk about intermediate accounting and just do a high level review of essentially the last couple of weeks. So not to slow us down at all and get us started here, we have financial accounting. We started out by talking about financial accounting is the identification, measurement, and communication of financial information to interested parties to assist in their capital allocation decisions. That is what financial accounting is. So that involves identification, measurement, and communication. Those are the 3 big things that we deal with when we talk about what is financial accounting. The next part deals with more of the objective. It's to provide information to interested parties in their capital allocation decisions. So we have interested parties. That typically is defined, when we look at the objective of financial accounting, that typically is defined as present and potential investors, lenders, and other creditors. That is who we're interested in. Mostly we're focused on investors as our primary user of financial statements. And they dominate the information set. That is largely because investors are very reliant on the information presented in the financial statements. They don't have access to private information like your lenders do. Banks have access to an immense amount of private information. So financial statements in the US are primarily going to be focused on investors, whether that is the present investors or potential future investors. So both of those parties are of concern here. So we're interested in both present and potential investors. So accounting helps in the capital allocation process. So what that ends up looking like is accounting provides information. Hopefully that information is relevant and faithfully represented. That makes it useful. So they provide that information to investors and other decision makers, which reduces the information asymmetry between, say, management and investors, with the idea that management has all the information they need about the company. They know whether the company is a good company or a bad company. Investors do not. So when we talked about the market for lemons, we talked about the need and the importance of that information, the financial information, and its ability to reduce information asymmetry and thereby helping to solve, I won't say entirely solving, helping to solve the problem of adverse selection. The problem of adverse selection, as we talked about with the market for lemons, is this notion that in the absence of the ability to distinguish high versus low quality goods, buyers exit the market and sellers exit the market, and it results in a market where only low quality goods are available for sale that no one wants to buy. And the market breaks down. That is what we're trying to avoid. That's called adverse selection. That's what we laid out in the market for lemons discussion. And accounting helps to solve that problem by providing useful information that reduces information asymmetry. So that is how accounting helps investors allocate their capital in the most efficient way possible. So with that said, then we have to figure out, okay, well, what is accounting? It's nice to have this very broad idea, but when it boils down to what am I following? I'm an accountant. What am I supposed to do? And that brings us to accounting standards. So generally accepted accounting standards, or GAAP. GAAP are our generally accepted accounting standards. They are established in the US by an organization called the Financial Accounting Standards Board, or the FASB. They set standards for essentially all for-profit companies. That goes for public or private. Now, if you're a public company, you must follow GAAP as promulgated by the FASB in the US. But you additionally have the SEC, which is the Securities and Exchange Commission. That entity is a regulatory body. They enforce GAAP for public companies in the US. So the SEC enforces it, the FASB sets it, and that is the general structure of the process in the US. So FASB sets standards. There is a very lengthy process involved in setting these standards that can take years. And sometimes it doesn't, they can go through the whole process or not quite the whole process. They can go through most of the process and still not even come up with an accounting standard. So that process generally involves a number of items. First of all, they have to identify an issue. They then do some research into it. They get public feedback. They issue an exposure draft, which is an idea of here's what we think the statement should look like based on all of our research and feedback we've gotten. And once if that goes well, they then can finalize the standard. So that is the process at which GAAP is established in the US. So there are challenges. It's a very good system. We've had it now in place for, good grief, almost 40 years, I believe. It's worked pretty well. No prior system, I think, has lasted 40 years in the US. We changed systems or changed entities setting GAAP numerous times because of they became susceptible to problems. Some of those problems are political influence. Now, there's a lot of entities or organizations that have a vested interest in how accounting gets set. Now, that involves management on the side of the company. Now, management is not always incentivized to reduce the information asymmetry between them and investors. They would like to control the information flow between themselves and investors, and GAAP reduces their ability to control that information flow by saying you must, as management, provide investors this amount of information, this set of information. Management's often not a big fan of that, so you see management push back on a lot of accounting standards. Other interested parties, investors, they're our primary users of financial statements, so it would seem to make a lot of sense that we should have their feedback. We have government involvement in accounting standards. There's times when essentially Congress has set accounting standards by basically making it legal or illegal to do something in your accounting records. They have ultimate law of the land. So if they feel like they want to change accounting standards, they can, rather simply by just making a law about it and making it illegal for companies to do X or report their financial statements in some manner. So that is how government can get involved. There are instances where that has caused all kinds of problems that we talked about in earlier videos. Auditors have to verify the financial statements. They have a vested interest in being able to verify them. They're on the hook if the financial statements are wrong. They're one of the parties that investors and other users will come after. So if they want to make sure they can verify the information, and there's numerous other parties that we're not going to get into, but there are a lot of parties influencing these standards. Now, there's a lot of challenges to establishing standards beyond just who has a vested interest and who wants the accounting standards to say one thing or another. For instance, there is an expectations gap. Now, this can be managed to some extent, but it's always going to be there. You could summarize this by saying the expectations gap is a shoot the messenger problem. The accountant is often the messenger because they are trying to identify, measure, and communicate information. Well, if that information is bad, there is a risk that the accountant is blamed for the content of the information, when the role of the auditor is merely to identify, measure, and communicate. It's not to create. Things. If accountants start creating things, we call that fraud, and you can end up in jail for it. So that's the expectations gap. Is this idea that people have a tendency to shoot the messenger, and if accounting portrays something that management or senior management doesn't like, they could get very upset and want you to change the accounting for something, even though it's maybe not appropriate or it's the wrong accounting, because they just don't like the way it's being measured and communicated. So those are some challenges. The international standards, there is a difference between US and international standards. Accounting changes. Accounting in the US is different from the accounting in Europe, which is different than the accounting in China. There's been some effort in the last number of years to conform accounting internationally to US. Now, the rigor at which that the conforming process happens has been, there's been strong segments and weak segments depending on largely who's in charge of the two organizations. But that poses a challenge. And then accounting, despite all of its efforts, it can't solve the ethical dilemma problem. Like, ethics is still important. You cannot regulate ethics. If somebody wants to steal from a company or misreport their financial statements, you can't write a standard that says don't do that. So these standards provide rules to follow. They don't provide ethics and the ability to do it right. So those are some challenges that we have in accounting. We try to address those as best we can, but they're always going to be there. So that wraps up largely the accounting environment. We next moved into the conceptual framework. So the conceptual framework comes out of the statements of financial accounting concepts that provide a kind of a foundation for our development of accounting standards. I had a little nibble right there. I snapped at it. We'll see. So conceptual framework. It's helpful in providing a foundation. Now that foundation becomes even more useful when we start trying to address new and emerging problems. So we have new problems that come out, new technology, new businesses, new entire industries like technology that come forth, and they introduce new accounting problems. The goal of accounting is that it's consistent across industry and across time as best we can. So having this conceptual framework to kind of lean back on when we start talking about something like how do we recognize revenue or expenses, it helps keep it consistent. It helps speed up the process of developing new standards for new and emerging issues. So that is largely the help of the conceptual framework. It also provides some congruency between standards so that when we talk about a current asset, we are talking about largely the same thing and not something totally different. So that's the goal of the conceptual framework. Now, the conceptual framework starts with us identifying what is our objective in accounting. So our objective in accounting, as stated in the Statement of Financial Accounting Concepts, is to provide financial information about the reporting entity that is useful to present and potential equity investors, lenders, and other creditors in making decisions about providing resources to the entity. So that's a fancy way of saying capital providers. So the objective is largely built into my earlier definition of financial accounting. So that is the objective that we're trying to reach. Now, the rest of the conceptual framework lays out how or what things do we think can help us towards achieving that objective. And we start out by identifying, well, what qualitative characteristics should we shoot for? So qualitative characteristics, there are two fundamental qualities that we're aiming for in accounting. One is relevance. So the relevance of GAAP financial statements. The second fundamental quality is faithful representation. Now, there are ingredients within each of these two fundamental qualities. Within relevance, we have predictive value, confirmatory value, and materiality. Predictive value, the information should help us predict what's going to happen within an entity or how an entity is going to perform in the future. Confirmatory value helps us confirm what happened in the past, and materiality is just saying, well, the information that is being provided is material to making our decision as capital providers. So if it's not material, then it's not relevant to my decision. That's almost definitional. So that is relevance. Faithful representation has three ingredients: completeness, neutrality, and free from error. Completeness, it has all the information necessary to make an informed decision. It's not missing anything or leaving anything out. Neutrality means it is free from bias. So management does not get to input its bias into the financial statements. Also, it is free from error. If it's wrong, it's obviously not faithfully represented. So there are their two fundamental qualities. Now, those are what we are seeking to achieve. Now, there are enhancing qualities that are good to have, but they are not objectives in and of themselves because, well, there's a limit to, or there's a cost to achieving them. Those enhancing qualities are comparability, verifiability, timeliness, and understandability. Those four enhancing qualities are something we aim for. We want to have financial statements that are comparable both across time within company and across company within the industry. As much as possible, comparability is a good thing. Verifiability, it helps if the financial statements are verifiable. If we can't verify it, well, then that allows the entrance of bias into the financial statements because it can't be verified, or it can't be, you wouldn't have two people come to the same conclusion. That's what it needs to be verifiable. Timely, if the information is stale, it's not useful. So we want it to be timely. Now, the other side of that is, well, we don't want to issue financial statements before we can make sure they're correct. Right? That's the cost of it being overly timely. And then understandability. Obviously, if people can't understand the financial statements, then they don't provide as much value as they would if they were understandable. So those are our qualitative characteristics broken down between our fundamental qualities of relevance and faithful representation and in the enhancing qualities. So we then move on to the elements. Now the elements are defined in the Statement of Financial Concepts. The elements fall into two broad categories. There are moment in time elements. These are what we refer to later as our real accounts. They're assets, liabilities, and equity. And then there are period of time or transaction or nominal accounts. These are investment and distributions to owners, comprehensive income, revenues, expenses, gains, and losses. So the Statement of Financial Statements concept statements define all of these elements. At this point in time, I wouldn't expect you to memorize the definition of all these elements. You should be familiar with what they are, to the extent that you need to kind of know what an asset or liability or equity is when we get to the accounting for them, to journalize them, because you have to know that, oh, if they bought a piece of equipment, that's an asset, right? But hopefully you're familiar with that and comfortable with that at this point already without memorizing the definition. We will be getting into the definition of these things much more extensively when we move on to dealing with the individual financial statements. So, but the definitions are largely contained in the elements in the concept statements. So those are the elements. They're part of the concept statements and part of our conceptual framework. Now, moving on to our what a lot of people would consider the third level. We have assumptions, principles, and constraints. Within assumptions, we have the economic entity assumption, the going concern assumption, the monetary unit assumption, and the periodicity assumption. So the economic entity means the entity is separate and distinct from its owners and other entities. That assumption is what gives us, it forms the basis of the accounting equation where assets equal liabilities plus owner's equity, with the idea that, well, for every resource, there is a claim on that resource, whether it be a debt or liability claim or an equity claim. It's also what gives us consolidated financial statements. So when we consolidate all the different legal entities under one entity and report their financial statements, that's an economic entity. We're consolidating legal entities under one economic entity. And it is the economic entity assumption that enables us to do that. Going concern assumes that the company will continue as a going concern into the foreseeable future. That's what gives us the ability to depreciate or capitalize and depreciate something. That gives us current long-term assets and liabilities. That's going concern. Monetary unit, everything gets denominated in dollars, or monetary units, which is dollars in the United States. And periodicity is that we can divide activities up into distinct periods. That's what gives us the ability to have an income statement with a 1 year or 1 month or 1 quarter set of information. That's periodicity. So with that said, I have a bite on the catfish line. So we'll go reel that in and get back to spinner fishing for bass in a second.